Hello everyone, my name is Ritika Shrivastava and I am working as an assistant professor in GL Bajaj Institute of Technology and Management and Greater Noida. So basically I will be discussing about the financial derivative topic lecture 2 session, and under that I will be covering the types of derivative and focusing on the two major types, forward and swap right now, and forward market transactions, and related to forward market contract I will be discussing certain concepts. Okay. So next is basically, so these are the types we are talk about. Let's talk about all the types. We can say these are the types of derivatives. First of all, swap. It flows from like this only: swaps, forward, futures and options. Why? Because when we talk about these two, swaps and forward, it's like internally. Why? Because these do not require any trade, do not trade in particular stock market exchange, and in this futures and options you can trade directly in that particular stock exchange market. So let's talk about first this swaps. Swaps is all about, basically it's linked to two categories. Companies also can make a contract between the two parties. One company can make a contract from another company with respect to some categories, like interest rate, in respect of interest rate or currencies. These all are included in this. And secondly, it can be make a contract with respect to banks also, connected with banks also. So according to the needs, this decided whether it's between the company to company only or whether it's connected to banks also. So we will discuss this later on. First, secondly, forward contract. What is this forward contract? It's basically a contract between two parties, and it includes certain types of commodities also with respect to making a risk management technique. Hedging is main criteria to control that particular risk. They hedge that particular funds. So for that, we are be focusing on these swaps and forward right now. Before moving forward, let's understand about some SEBI guidelines first. Okay, before entering into any kind of market, trading market or trading platform, you have to first discuss about the SEBI guidelines. So first point is the use of an online screen based trading system for derivative trading. So as you know, whenever you go for a stock market exchange and trading in the stock market, there must be a online screen based trading system. Online screen based trading system should be required as per the SEBI guidelines. Next is to prevent market manipulation. Prevent market manipulation, the derivative exchange or segment shall have online surveillance capacity to track positions, prices and volumes in real time. So when we talk about this statement, we are talking about here, first is real time. What is this real time? अभी आपने एंटर किया कोई कॉन्ट्रैक्ट में, या फिर आपने अभी शुरुआत की ट्रेडिंग में, तो एट दैट पॉइंट वट एवर द प्राइस इज दैट, volume is that is what is real time we are talking about there. So in that case they have to track this particular price and volume at this current real time, and this will help to prevent market manipulations. So this is the second point. First and third point is derivative exchange segment should have plans in place to provide for the real time transmission of information regarding deals, volumes, quotes over at least two easily accessible information vending network for investors across the nation. This means that basically when we talk about they have to provide certain information, clear information of the real time to the investor regarding the whatever the deals, regarding the volume and regarding the quotes for over the at least two easily accessible information. So it should be transparency with respect to the information showing related to this volume, quotes, deals, and in real time we are talking about. Just now I have explained real time. Next is the arbitration and investor grievance redress mechanism. Okay, this is the point. For the derivative exchange segment should be operational from all four areas of the nation. So when we talk about investors, they can have some issues also related to all these like dealing with a particular person or trading in that particular platform. They have some like kind of problems related to that losses also. For that, for the benefit of that particular investor, there is a like kind of mechanism they have created, arbitration and investor grievance redress mechanism. So this should be operational, SEBI says operational from all four regions of the nation. This is what another guidelines for the SEBI. Next is the SEBI exchange segment should have a reliable system in place to keep a track of investor complaints and stop trading irregularities. So just now I have explained some of the kind of issues also having with the investors related to their dealings, related to their trading, or any kind of complaints they should be having. So in that case, डेरिवेटिव एक्सचेंज सेगमेंट शुड हैव अ रिलायबल सिस्टम. उनके पास एक सिस्टम होना चाहिए प्रॉपर टू ट्रैक दैट पर्टिकुलर इन्वेस्टर कंप्लेंट्स. They have to make a proper record, so that the trading should not stop in between trading or in that particular platform. It will create some irregularities. So that's why for ignoring that irregularities in the trading, they have to keep some record of the investor complaints. The exchange derivatives segment would have its own investor protection fund. So also along with that particular redressal mechanism, they should also having investor protection fund. By the help of this investor protection fund, investor could able to manage their losses. Any losses they are like kind of occurring, they are kind of getting in that particular trading. In that case, they can have this particular fund. Next is the clearing corporation house must undertake full novation, which requires it to act as the legal counterparty to both legs of every trade. Alternatively, it may offer an unqualified guarantee for the settlement of all the trade. So in this case, it's talking about the clearing corporation house. So this is the system where all the settlement, all the money settlement, all the transaction settlement dealing are clear with respect to whatever the complaints, whatever the help the investor is required. So in that case, they can help the investor with respect to, we are talking about, which require it to act as a legal counterparty. So legally they must help and to both legs of every trade. It may offer an unqualified guarantee. They can also offer some kind of guarantee for the settlement of all the trades. if any kind of issues or settlement require. Next point is the initial margin requirement for index future contract. What is this index future contract? Basically one of the type of derivative contract we can say within that particular trading platform. Index future, it means we are trading directly to stock exchanges like Sensex prices on the Nifty prices, Nifty 50 prices. So, we are directly dealing with that particular Nifty 50 prices and Sensex prices. So, in that case shall be based on the positional risk of loss, and the appropriate level of initial margin shall be determined using the value at risk principle. So, what is this value at risk principle? When we talk about this principle, it says some formula right now, kind of like formula. They calculate the risk, expected risk factor, financial loss, whatever they will be going to bear if they will be investing at that particular price. So, they predict some like kind of losses, financial losses. In that case, that says that will help to manage that particular losses if this initial margin will be set according to this principle. Initial margin will be set according to this principle, then it will be helpful for the investors to manage their particular losses. The starting margin should be sufficient to cover the potential one-day loss on the trade on 99.99% of the days. So, this is the we are talking about initial margin requirements with respect to trading, with respect to whatever the losses they are facing, the investors are facing. Next point is clearing corporation house must be able to separate the initial margin deposits made by clearing members for trades executed on their own account. So, they should have some separate deposit for like whatever, because sometimes they are investors don't know about that particular losses they will be facing later on, or you can say for that they must have a separate deposits with respect to that. In that case, clearing house must keep that particular client's margin funds in trust for their exclusive use and must not permit their diversion for any other use. So, suppose you just entered into that particular market and you started trading. In that case, what happened? You just don't know, you are not aware of proper losses you will be facing, okay, and you are going on trading and you are into an losses for a time being, and in that case it will help, this fund, this deposit will eventually help, because and this one more guideline is says that that particular deposit fund should not be diverses for another use, okay. ऐसा होता है कि you can do like kind of for another use you can also use that particular money, particular fund, but it is not permitted, it must be not permitted according to the SEBI guidelines, so that you will be able to bear that particular losses. So, here comes all the, we have discussed all the that SEBI guidelines here, and now let us move on to the forward derivative, one of the type of derivative we have talked about. So, what is this all about, forward derivative? A contract which is made between two parties, buyer and the seller, for the purpose of purchasing and selling something. Something is all about, we are talking about here any underlying asset. We are talking about underlying asset at a future date. which is accepted on current date. Okay. So, this is what is forward derivative. Let me take an example for a clear view of this particular concept. Suppose a company who want to buy coffee beans. So, that company will eventually go to that coffee estate, or you can say make a dealing with that particular coffee estate, or in that case what happened, if that company did not make any kind of contract with that particular person, so in that case it's not be flexible with respect to conditions applied, with respect to the flexibility of that particular prices. So, in that case, suppose that coffee bean price is what, 500 per kg, rupees 500 per kg, that coffee beans is pricing at this particular rate. In that case, what happened? Suppose they entered into a contract. Okay, this is forward derivative is what? It's a contract, it's kind of contract between two parties. So, here are two parties, and in that case we have said they have entered into a contract. So, company let's suppose A company entered into a contract with coffee estate, and they decide some like time period they will be taking, let us suppose 3 months from now, like what this is saying, future date, at a future date. So, that is why I am saying here 3 months from now, and which is accepted on a current date. And why, what is this current date? Current date is 500, and so they will kind of negotiate with each other. One fixed price they will set जिसमें जिसका फ़ायदा हो जाए, मतलब लाइक एक फिक्स प्राइस हमने नेगोशिएट कर लिया. हम कभी नेगोशिएशन करने जाते हैं, जो कोई भी हमने सामान खरीदा, तो फिर हम ट्राई टू बैलेंस दैट पर्टिकुलर प्राइस, वी जस्ट नेगोशिएट विद दैट पर्टिकुलर पर्सन. भैया कहते हैं 5 रुपीज़ आप रख लो, 5 रुपीज़ मैं रख लेता हूँ, मतलब कि 10 रुपीज़ का मुझे दे दो, आपका प्राइस 15 है और कहते हैं मेरा प्राइस 10 मैं बोल रहा हूँ, तो फिर आप फिक्स कर लो. सो दिस इज़ व्हाट इज़ हेयर इट्स डूइंग. सो they both should not get into a proper kind of losses. For that, controlling that thing, the forward derivative will help to reduce that particular risk factor, and that is what is called hedging also, hedging that particular risk. Hedging in the sense controlling that particular risk factor. And then they have decided that time period 3 months from now, and they have decided some certain price, 480 rupees per kg. So, they have decided this 480 rupees per kg. Now, what happened after 1 month, or you can say after 2 months, what happened? The price, this 480 falls, price 480 falls. In this case, company will make a loss, kind of loss. In that case, why? That company is kind of purchasing that particular coffee beans at this rate, and in that case, if that person after this reaching at that point 420 rupees, अब 420 rupees आ गया, नीचे गिर गया प्राइस, क्या हुआ कि कहते हैं कंपनी ने तो 480 पे खरीदा था, उसको इवेंचुअली लॉस हुआ, बट एक फिक्स प्राइस हो गया कि कहते हैं आगे अगर बाय द वे इसका प्राइस बढ़ जाता है, सपोज इट गोज ऑन 520 rupees, so then that company will go on benefit. So, this is the contract they are making, and other party, coffee estate also vice versa, you can say, If this prices increases 520 rupees, it will be definitely a loss for this particular coffee estate. So this is all about forward derivative contract. So this can't be traded with respect to, we are talking about here, they can deal in agriculture commodities or any agriculture commodities, like they can trade in rice also, pulses also, all these can be also involved with respect to this derivative contract. And also you can metals also, certain metals, they can make a contract with respect to metals also. So all these things are included in coffee bean. Next is basically the forward derivative concept, OTC agreement. So it's a kind of OTC agreement, over the counter agreement. So it says that it automatically explains that it benefit both the parties with respect to making a common agreement between the two parties, and fixed rate or predetermined price, you can say. This is the predetermined price also one of the feature, and dealing at future date, you can say. That's what we have talked about in example, agreement between two or more parties. Buyer long position or seller is short position. What's this? We will discuss this in next slide. This is connected to payoff on forward contract. As payoff on forward contract depends upon long and short position with respect to buyers and seller respectively. Okay. So in that case, buyer will be regarded as long side, and obligation to buy that particular asset, they will be said as long position. So this is what is long position, and in that vice versa, you can say seller is regarded as short side, and obligation to sell that particular asset at a particular price, agreed price, is short position. So in that payoff condition, we can discuss that in long position they make a profit when price increases, and in short position they make up profits when price decreases. An example, you can say, it basically says a formula which denotes that particular long position, whatever the payoff for your investment. This is the formula. What if delivery price denotes K. What is this delivery price? Delivery price is basically at that point of time whenever you making that particular contract and you enter into that particular contract, at that point whatever the price you have decided. This is what is delivery price. Spot price denotes S. This is what spot price is, current price at that particular trading platform. What is the current price when you are thinking of that entering into that particular market, and time at which spot price expires, time T. So there is the payoff formula, S into this spot price into time expiration minus this delivery price. For the short position, the payoff formula will be vice versa. Then K is what basically denotes delivery price minus spot price into time. This is what it shows. This is the position of the short position. That's what I have said. Price goes down, and in the case of long position, price goes up. And in the case this is what is price at maturity, when both the prices, spot prices and the forward prices becomes equal. In that case, it's the position. Next is forward market in India. In that case, you can say these are two categories through which we can discuss about the market position. Risk factor, you can adjust your risk with respect to that. Transactional risk basically exposures it says that you are allowed to enter into that particular market or agreed or balance your particular pricing up to the amount of the underlying asset, up to the amount of the underlying asset. But in the contractual exposure, you are flexible to that particular dealing with that particular price. The next is swaps. Next type of derivative is swap. Swaps are private agreement between two parties to exchange cash flow in the future according to the pre-arranged formula. They can be regarded as portfolio of forward contract. So basically swaps are related to, just now I have said, it will help you to exchange that particular currency exchange. You can also focus on a currency exchange, you can also focus on interest rate exchange. How would it will help? Like suppose an example, you can say a company A is interested, company A is sitting in US, okay, interested in expanding its business in UK. So in that case, company B who is sitting in UK interested in US market, investing in US market, in that case what happened, they are taking a loan from the bank. What happened, US bank offering 12% rate of that particular rate, loan rate, interest rate, and UK offering 13% interest rate. In that case what will happen, they will be kind of increases rate is that, in that case they will be making a kind of losses if we enter into that particular market. So for that particular balance, making a balance, they are making that rate fix, interest rate, and they try to swap that particular exchanges. But in this case it should be the principal amount should be similar to both the companies. This is what is swap is all about, and these are the types of swaps: interest rate swap and the currency swaps. So so that's it. These are the references, you can refer to this, and thank you.